call the February 2025 Investment Advisory Committee meeting to order. First, I want to welcome 5 new members, or 4 new members and 1 long-serving and well-appreciated member, 2 of them in person, 3 of them by Zoom. The 2 in person, first, Robert Durden. Robert is the CEO and Chief Investment Officer of the University of Virginia Investment Management Company, where he runs that organization across all asset classes. Robert is a North Carolina native, been born in Winston-Salem. Also, we worked together for some years in Chapel Hill, so has deep roots in the state, and appreciate his service and willingness to be here. Dan Ward. Dan is the Chief Investment Officer for the Greenhawk Family Office here local in Raleigh. Before that, he was Chief Investment Officer at the Virginia Tech Foundation. So we've got all our Virginia bases covered. Thank you, guys. Dan is the only, besides myself, non-North Carolina native on the board, but he does live outside of Charlotte and commutes to Raleigh every week. So I appreciate him being here. By phone, we have 3 members. First, Lentz Brewer. Lentz is no stranger to this committee, having served on it for a number of years, having served on the TSERS and Elgers boards for over a decade now. We appreciate his willingness to both serve on this committee and those. It's a lot of work and it takes a lot of his time. So thank you, Lentz. 2 more members, new members on the Zoom. First, Michael Kennedy. Michael is based in Atlanta, Georgia, where until recently he was a senior partner at Korn Ferry in the asset management practice there. He is involved in the Georgia retirement system, and he's deeply involved in the University of North Carolina, particularly around the endowment management function there. So thank you for your willingness to serve, Michael, and for being on the phone. And then last but of course not least, Jamie Spencer. Jamie, Durham, North Carolina native, Wake Forest grad. Also a former colleague back at Morgan Creek. He works at Pathstone, which is formerly Hall Capital, where he is one of the managing directors there, managing client portfolios for a number of clients in that capacity. So excited to have all of you on board. I appreciate your service. We're now getting an Amber Alert. Awesome. Anyway, thank you for that. And moving on to the Pledge of Allegiance and the salute to North Carolina flag. So will you join me in doing that? Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the Old North State love, loyalty, and faith. All right. Thank you. All right. I will now ask the legal counsel to call a roll.
Hey. Good morning, everyone. My name is Jason Sass, and I serve as Deputy General Counsel at the North Carolina Department of State Treasurer. First, I'll take a roll call of the committee members to confirm we have quorum. Then I'll go over a couple of reminders for public meetings. So, for the roll call, Mr. Lentz Brewer.
Present. Good afternoon.
Good afternoon. Mr. Robert Durden.
Present.
Mr. Michael Kennedy.
Present.
Great. Mr. Jamie Spencer.
Must be on mute. I see him.
Yeah, I'll give him a moment. Mr. Dan Ward.
Present.
Treasurer Briner.
Present.
And one more time for Mr. Jamie Spencer.
Present. Can you all hear me?
Yes.
Yes, thank you.
Thank you.
Treasurer, we have quorum.
All right.
So reminders. So thank you, committee members, for your patience. Here are some quick reminders for public meetings. For those who have called in, please remember to mute your phone when you are not speaking. Please state your name when making or seconding a motion. If you need to leave the meeting, please speak up to let us know. And if you rejoin, please identify yourself. For anything that this committee votes on, the votes will all be by roll call. We'll deem the members who make the motion and second as voting yes. Finally, a reminder to anyone speaking from the audience during this meeting, please remember to stand and clearly state your name, title, and organization for the record before proceeding to speak or answer a question. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website, www.nctreasurer.com, at the Investment Management Division page. If we lose the phone line connection altogether, the meeting will be deemed to be in recess, and we will put a notice on the nctreasurer.com website homepage when we have information about a time to resume the meeting. Are there any questions about these procedures? Okay, thank you. At this time, I'll turn the meeting back to the chair for approval of the last meeting's minutes.
I now entertain a motion to approve the meeting minutes for the November 20th, 2024 Investment Advisory Committee meeting.
So moved.
Mr. Ward.
Second.
Mr. Durden.
Second.
Okay,
Thank you.
for the roll call, Mr. Brewer.
Aye.
Okay, Mr. Kennedy.
Aye.
Mr. Spencer.
Aye.
And Treasurer Briner.
Aye.
Treasurer, we have approval.
All right. Thank you. So now let me turn to introducing the Investment Management Division team who is here and who will carry us through most of the important discussions that we need to have today. First, Kevin Sigrist. Kevin joins us or rejoins us as the Chief Investment Officer, having been here for a number of years through 2017. And so we're happy to have his steady and important leadership for this division. Next to him are Chris Morris and Jeff Smith, who served for a number of years as acting co-CIOs and have now returned to do the work that they love even more than that. So thank you guys for being willing to serve in that capacity and for all the value that you create for citizens of North Carolina. And then half the room, all the folks here on the investment management side, thank you for being here. As you know, we have a lot of work ahead of us, and I'm excited to partner with you all in that regard, as is the rest of the Investment Advisory Committee. So thank you all for being here today and looking forward to this important discussion. So with that, over to you, Kevin.
Okay, great. So we've got a couple of agenda items today. We'll start with major initiatives. We'll walk through performance. There's a very heavy slide deck on performance, but I'm not going to go through all those slides. They're there so that it's a good record and you all can drill as deep as you want, prepare for the meetings and also ask questions. And we have the team here to answer some of the detailed historical performance questions as well. So you'll tire of my monotone quickly. And so I would encourage, questions from folks in the room as well as those on the phone. And either I'll answer them or I'll hand them off to the team. We'll talk about the kind of recommended changes to the investment policy statement, which are really just going back to a strategic asset allocation that was there in 2022 and before, I think back until about 2013 or so. And then the final piece we'll take up is around the future agenda items. So since this is our first time with you all, we would encourage you to give us feedback either during the meeting or afterwards around what you'd like to see on the agendas, how you'd like the topics to be handled and that kind of thing. So I'll get started on the major initiatives. This will be a standing item and where the purpose is just give an update so you have clear sense of like where we're intending to head with the investment program and all the things that are necessary to actually be successful over the long term. So we'll, eventually talk about things like human capital, organizational structure, things like that. So the meetings aren't always just about performance and how we expect to deploy cash and so on. So the major initiatives we've got going on at the moment are around rebalancing, investment governance, and our asset liability study for the retirement systems coming up. So on the rebalancing, and I'll step through a lot of this fairly quickly because when we did our one-on-one orientations, I covered some of it. But I've got a bit more detail to kind of illustrate what we're trying to accomplish within asset classes, not just across the asset classes for the rebalancing. So the first phase has already started. That's really in the first quarter of this year. Treasurer has approved certain components of it already, but some aspects are contingent on approving the changes to the investment policy statement, which is, again, one of the items later. The phase two will be pretty much the balance of the year. So when we come back for the next meeting, what we want to do is walk through with kind of active presentations and discussions with each of the leads for the asset classes, what our pacing plans are. and where we want to lean in and or de-emphasize certain components of the asset classes, market sectors, and so on. I think that'll be a great opportunity to kind of hear how the portfolio is actually constructed down within asset classes and then get feedback from y'all. And then phase 3 is again, second half of the year mostly. From August forward, we'll be working with you all on the asset liability study. So where did we start? Here we're starting with Jan 31 for our asset allocation stance. And the third column from the left is our current strategic asset allocation. So that's what's approved in the investment policy statement. I've highlighted 2 key rows, public equity and cash, because if you look at our current stance, it looks like we're overweight about 4% in public equities. And that's global, so you can think of that as an ACWI type mandate. And then in cash, we're about 2% overweight. But one of our later agenda items is a recommendation to move back to the strategic asset allocation that was in effect prior to 2022. And it's those 2 asset classes that really are where the changes occurred in 2022. So prior to 22, the strategic allocation for public equities was 42%, pension cash was 1%. And that's what we'll be working against when we show you some of the planning slides and how we're implementing the rebalancing. 2 bullet points on the bottom. One just summarized what I just said. The other is a good reference point. We don't necessarily want to be like other public pension funds in every regard. But in terms of a big picture factoid, the average public pension fund has about 47% in public equities and about 24% in fixed income and cash. Some of that fixed income is not just investment grade, which is where most of our portfolio is focused. Some of that is high yield, non-dollar, and so on. But this is a good measure of kind of the big risk dial. And we've been, for many, many years, amongst the lowest risk postured public pension fund in the U.S. We would measure it through consultant studies as like what's our equity beta and the sensitivity to the equity markets. We were usually like one of the 3 lowest of all the public pension funds that we had data on. And that equity beta or the risk positioning has actually gone down quite a bit over the past 8 years because of the buildup of cash and then the lowering of that public equity allocation.
Kevin, I believe we'll talk about this later, but our net cash needs per month run to the 10 to 20 basis point range. Is that right?
Yeah, it's about, we pay generally between 100 and 200 million a month net out. So that's about right.
So as you think about the need for cash, the need for liquidity, 20 basis points a month is about the zip code we've been in for quite some time.
Yeah, quite some time. And that's a function also the level of contribution rates, right? So the contribution rates are fairly high at the moment for the retirement systems, the 2 main ones, teachers and state employees retirement system, as well as local government. And we have a chart later on in the performance slide deck. Chris will walk through how we measure liquidity and then the external demands.
Kevin, question is so the reason we're 87% funded, which I know was ranked 14th, I think I saw on the slide, is because the contribution rate so high. That's offset the lower risk, essentially.
Yeah, exactly. And that's the fundamental feedback mechanism for a pension system, right? So if you're not fully funded, then there has to be extra contributions that come in from employers or employees, depending on the system's governance. And if you're under fully funded for extended periods of time, those contribution rates just keep creeping up, which has happened certainly in the North Carolina systems. Yeah. So the phase 1 rebalance, to go a little bit deeper on that, the plan is to redeploy about 40% of excess cash. So right now we're looking at about 7% excess cash. So we're talking about using about 40% of that. And what we want to do is deploy that to liquid uses. We can't force it out on the private side and that wouldn't be prudent. But there are some reasonable places to put excess cash, we think. So on the growth side, it's a rotation into public equities, as well as some in opportunistic fixed income. We consider that to be return seeking, so that falls into growth. On the investment grade fixed income side, so this is all very high quality U.S. Treasuries, investment grade corporates, and Ginnie Maes. That's all run internally. We look at that as an opportunity cost. Cash is yielding about 4-ish over the next year, depending on what the Federal Reserve does. And we have about an 8-year duration on our IG book. So there's definitely interest rate risk associated with that. But we think the risk and return are really kind of asymmetric. And I'll show you our view of that when we think about it over a 12-month period. And then we have some areas where we have some liquid portfolios that we can add cash to that are really focused along the credit spectrum, credit rating spectrum, but it's low duration asset-backed securities like CMBS and RMBS and things like that. And that's another place where we can allocate into, and I'll show that in a bit more detail in a second. So big picture, if you think about sources and uses for the excess cash, what we're talking about across the asset classes is moving about $1 billion to public equity, about $560 million into opportunistic fixed income, pulling $3.3 billion out of cash, and then also allocating $1 billion of that into our longer duration investment grade fixed income, and then about $700 to $800 million into inflation sensitive. Right. We have I'll talk about the pipeline that we're currently working, which is more relevant for the illiquids and private equity, real estate, and so on. So that's got a lot of things that we could be doing, but that's a longer burn to get those through all the negotiations and some of the diligence steps as well. So what if we follow through on that movement, this shows what the pro forma allocation would be. Obviously, the markets move all the time. So this is as of a moment. Markets have moved a bit since. Our view is we're never going to get the timing right. And we have to be thinking about this for 1 year and longer horizons. And so that's how we approach things. If the world were to suddenly shift due to some exogenous event, then of course we're not mechanical. We would pause and reconsider the plans. And obviously, we talk daily with the treasurer, but also with the IEC. We would involve you all in kind of any rethink of this. So on the public equity side, the chart here is really just showing kind of before and after modeling of where our risk comes from. And within public equities, we've been unbalanced. So we've been underweight the U.S. by about 4%. We've been overweight foreign or non-U.S. growth. There has not been regular rebalancing within the asset class. And so misfit risk is just we're positioned differently, like I described. There was not really, and still isn't, a market view to support that positioning. So our view is then we should eliminate the risk. So that's what this is about. It brings down our active risk or our tracking error pretty significantly, and our total risk tracking error, I should say, for the asset class. However, in thinking about where we want to allocate, again, we want to be market sensitive. So we're doing, if you think about the entire movement within equities, including new money coming in, it's closer about $3.5 billion of buys. And because we're doing internal rotation as well. So we're defunding some exposure we have on the foreign side, foreign equity side, foreign growth in particular, moving that over to a Russell 1000, but also funding a U.S. small cap and then a U.S. factor, internal factor based portfolio. And that's what this shows on the core factor tilt. These are kind of the quant metrics around our underweight that's systematic in this portfolio to the Mag 7, the large growth, momentum, kind of biased names, and more focused, more weighted towards smaller cap value and those types of exposures. So we think that that's a reasonable hedge, if you will, against some of the valuation concerns that we have around the Mag 7 and some of the other kind of momentum-driven parts of the market.
So again, you said of that roughly $3.5 billion, kind of disproportionately buying the Russell 1000 to address at least partially some of the underweight to the U.S.
So it's about $1 billion going to the Russell 1000. And how much to the core factor? A similar amount, John?
No, so it was 2.2 billion total to the Russell 1000.
Sorry. Yeah, 2.2. Yeah.
Yeah, because $1 billion of new money and then 1.2 of the reallocation. And then, about $1 billion or so going to the core factor.
Yeah. 300 million, I think, going to a small cap ETF. Yeah. So that kind of, from our perspective, spreads it out a bit in terms of the risk. Yeah.
Kevin, two questions. Within small cap, is there any quality overlay that you're putting, or are you just buying the index within the small cap space?
At the moment, it's just getting the placeholder exposure with the ETF. And then over the next 3 to 6 months, we'll have searches for active managers in that space. So we're fairly constructive on active small cap. And so that would be our plan. But it will take a while to kind of create the search, reignite the relationships and that kind of stuff. Yeah.
There's not an existing manager that you would want to.
Rhonda?
That I want.
That you'd want to add to.
Why not?
Like to start a new search.
Rhonda Smith, Director of Public Equity. Not a specific manager. There are areas that we've seen that seem to be more attractive in small cap. And part of the challenge that we have in that space is putting a large amount of money to work because, most of them have been limited. We're not seeing that as the case right now. So I think we've got better opportunity set. But looking at quantitative strategies in small cap do well. We may evaluate if there are any activist exposures in that area as well. And then, we've got currently a growth manager and a core, so maybe some small cap value as well.
Thanks, that's great.
Okay. On the fixed income side, the IG side, here, as the chart shows, we've had a backup in yields that are fairly attractive. Within, this portfolio, we have a significant allocation of corporates. There, the spreads are quite narrow, so we're sensitive to that. But on an absolute yield basis, we think it's attractive. We also like the kind of asymmetric payoff. Jeff, do you want to talk about that a bit?
Yeah, I think the key thing we see here versus what we saw just a couple of years ago is we were in that really low environment. We were much more sensitive to the price return, how it impacted the total return of the asset class because we had no income. And now we're at a point now where there's a little more income cushion that we didn't have for a number of years. We were sub 5% on a yield basis for, I think, 12 years in a row from 09 to 22. So we're at least back in a level where the expected returns of the asset class are more attractive and you got a little more downside from income.
I think if you look at the extremes, so these aren't predictions, right? But if you look at the extremes of the analysis, if we have 150 basis point decline in rates, then the return over the next 12 months is about 17%. If you look at the flip side of 150 basis point rise, it's about a 5% loss, right? So that's the fundamental aspect of having these high income returns. Again, on the corporate side, because spreads are so narrow, we've also looked at, what happens if you have 100 basis point blowout in credit spreads. And if you couple that with 100 basis point parallel shift, that's still only a minus 4% return. We don't want a minus 4% return, but given the kind of the types of risks that are out there across the whole spectrum of equities and fixed income, we're okay with this type of risk.
That's typically going to be on the extreme side because typically, if we get that kind of spread blowout, it's going to come with some weak economic data that's usually going to push rates the other way. We had the exception in the last go round, but I would say over time, that's the case. As Kevin mentioned, the reflection on where we're concerned about valuations. Yes, it's hard to see much value in compressed spread where we are in IG. The backstop is the absolute number is still attractive on it, and credit fundamentals are really in pretty good shape as a whole. But as part of the rebalancing, that was an area we really de-emphasized. There was very little of that going into corporates to reflect kind of where we were exposure-wise.
And for what it's worth, I think the comment you made on credit fundamentals is underappreciated by the markets right now. Like, they're so much better today, corporates, than your normal single A corporate would have been 5 years ago, because they're the one part of this world that refinanced at really low rates, during the bottom. So.
Yeah. So the flip side, though, of what we think is asymmetric risk is that last mile fight against inflation has been really tough. And in fact, we've seen recently market expectations start to kind of look towards higher inflation, more inflationary pressures, which is also coming through the actual CPI, core CPI, whatever measure you want to look at in the U.S. And so we are also allocating into inflation sensitive. And what we see with inflation sensitive is these are high credit quality asset-backed securities, like in the CMBS space, to a certain extent in the CLO space as well. So there you have floating rates. So we like the low duration, like the high credit quality. And if in fact inflationary pressures go through a second cycle, which has happened historically, then we do have some way to participate, at least kind of hedge out some of that risk that we would otherwise be carrying on the long duration portfolio. This is a measure or set of measures for one of the sample portfolios that Ron Funderburk and his team are working on. And so the additional allocation in the kind of the middle column, or 3 from the left, these are not super exciting returns, right? 6%, but the duration is less than half a year. Weighted average life is about 3, and decent liquidity. So we like this, very high credit quality, good return for kind of the risk that's taken. On the other side, again, this is something that Ron and team are working on, is we can go out the credit spectrum and get very similar types of exposures in terms of duration and weighted average life, lower credit quality, and there the returns are much more compensating, right? So here we're at 9% is kind of what's being priced with the some of the managers. We can do that. We have a long short credit fund, which has worked out very well with us or for us over the years, a long-standing relationship. And we can do this through some private relationships also that are more of a capital drawdown vehicle. And look at CMBS, the SASBs, the single asset. And these, there's been a lot of kind of flow in this over the last couple of years. But for our purposes, it seems to fit reasonably well. Okay.
One other place I would suggest to look at it, I would look at the CRT B2 space if I were you, below loan to value. That's actually probably more inflation protected than the CLO space. Mm-hmm. So just something to throw in your bucket. So.
Okay, governance. So this is something that is required under our statutes. And sometimes the connotation is required by law is negative, but we actually were the advocates for this back in 2016, that we think it's good governance that at least every 4 years, the department gets a third-party consultant that can look at the overall investment management division's investment programs to look at governance, operations, and our investment practices. And so what the law was constructed so that the scope of this would be reviewed with the IAC, and then also the final report comes back and the consultant, in this case it's RVK, a multi-office, but they're based out of Portland. And they would do this work and then they would come back. So I want to review the scope quickly, and then to the extent you all have comments, suggestions, we can incorporate those into the scope and move forward. So the primary components of this, what we're calling the working scope, in case there are changes, is they look at the current authorities, and basically much of what we do is really driven by statutory limitations and authorizations. And so they'll look at North Carolina law and look at common best practice. I expect fully that they'll come back with, one of the things that was recommended 4 years ago was eliminate our legal list, right? So the legal list is this somewhat complicated part of North Carolina statutes that sets out specific definitions of what we can invest in and then the maximum amount we can invest. And we've worked constructively with the General Assembly over many years to fine tune that. But that legal list, particularly its degree of complexity and these specific limits on how much we can allocate to different types of asset classes or asset types, is really now out of step with how most states work. And we know on the corporate pension side, both defined contribution and defined benefits, there's about $13 trillion invested there. They don't have any legal list that applies to them. They have certain federal restrictions on investments in places like Iran or Chinese military companies and things like that, but they don't have anything like we have. So the other thing that will most likely come up, and it's a current part of what the department is working on, is to look at the overall governance of the investments, particularly the retirement system investments, to move towards a board structure. So they'll look at that, and RVK has done a fair bit of work on that for other clients in the U.S. As well as overseas. And so we would expect to see some input from them on that particular topic. They'll review our key policies, which are listed here, the investment policy statement, our selection and our monitoring policies. We have a raft of other policies as well. Then they'll look at our compliance processes around internal trading, private markets. We have had some recommendations come across from time to time around segregation of duties and how we do our conflict walls for material non-public information. And those have been taken on board, but the world is always evolving, so we may get some additional recommendations there. And then the final piece is around transparency and accountability and ethics. They'll look at how we compare our requirements to other state plans and make recommendations. So the key parts, you've all gone through the ethics training now with Jason, so you're familiar with that. But we also have something here called the investment transaction disclosure policy. And that's really focused on sourcing, use of placement agents, social connections that might influence our investment decisions. So we have a very rigorous set of conflict checks, which look at sourcing, and then we do substantive conflict checks as well in the course of negotiating documents and things like that, which you all would have dealt with yourself. How are conflicts disclosed within partnerships? What's the role of a limited partner advisory committee and those types of things? The investment transaction disclosure policy is more around placement agents and those things. So that's the scope. So if you all have suggestions.
Kevin, this is Michael Kennedy. I've got a couple of questions. So from a governance standpoint, you're using RBK. How long have you used that particular firm? So is there a good institutional knowledge and history there?
With RVK, I'm not sure how much the department has used them before. Yeah, we get a quarterly reporting service from them, kind of gratis, as a consequence of us submitting our performance information. So we get some like peer analysis from them. I've known RBK and a number of the consultants there kind of over the years, going back to my Florida days, and as well as more recently, I've worked with them as well. So I know the firm quite well. Yeah.
Yeah, it's got a great reputation, so I'm a fan of RBK. I was just curious to see if they've been doing work for the state for the last 10 years or some period of time like that. And then the other thing is, even though it's not part of the mandate for RBK, but I would probably include this over within the overall bucket of governance, is compensation consulting, which is a different discussion. And typically, the approach would be to bring in the comp consulting to look at compensation for members of investment organization. So I would probably include that. And I know you are thinking or have used another firm in the past.
Yes. So historically, and this goes back to my time here, we worked with Mercer to do a market-based compensation study. And that came on the back of also getting legislative authority to do that. So that's another example where the General Assembly was supportive of recognizing kind of the unique circumstances of an investment organization embedded in the state, right? That we compete, we have strategic risk in terms of recruitment and retention of experienced investment staff. So I think the plan is probably later this year to run a formal process to bring on a compensation consultant to refresh that study, revisit the structure as well. So I think, there's interest. We looked at this last time, and I'll get to the punchline as it relates to the IAC in a bit. We looked at a structure last time of base plus incentive pay or pay for performance. At that time, the decision was let's stay with just a base compensation structure. But I think that needs to get reviewed again and then brought to the treasurer as well as the IAC. So the punchline is last time when we did that study, we involved the IAC in assessing kind of how that, what the results of the study were like, as well as opining on structure and the pros and cons and even implementation. So, that would be my recommendation to involve the IAC again, given everybody's experience in these matters and responsibility for kind of managing teams and getting results. Yeah.
Evan, this is Jamie Spencer.
Thank you.
Michael beat me to the punch with the compensation question, but the other question I had is, could we see a copy of the 2021 study?
Yeah. Thank you.
The other thing I would add to that, Jamie, and maybe to brag on Michael for a second, is we'll send you the 2014 governance task force review, of which Michael was the chair, because it lays some of the groundwork for what we're trying to do comprehensively in governance reform as well.
Thank you. The other part of, I'll put it under governance, is we have a number of vacancies. So we're in market. We're making good progress, I think. And we have 8 current vacancies plus 1 anticipated due to a retirement later this year. And so we have a pretty good pool of candidates for portfolio manager level as well as analysts. And over the next month or so, we hope to get that narrowed down, do the interviews, and start to get offers out. We've also got 2 director levels. So in our world, a director is the head of an asset class team. So it's a senior level posting. So we have a person we brought on recently, Andy Hoffman, who has roughly 30-ish years experience in real assets, both as an investment banker as well as on the asset management side. So he'll be working alongside a couple of our folks, Ron and Troy, on various components of real assets. And then we have another person who will be joining us in mid-March at the director level, rejoining the team. And he'll be taking on multi-strategy and building that out. That's currently got a 2% allocation of the plan, so it's material, but it's very focused on two legacy relationships, so there will need to be some restructuring and redeployment. Couple words on the asset liability study, and then I'll pick up the pace. So the issue on, the thing I want to kind of emphasize on the asset liability side is this is really one of the more important tasks that we take on about every 3 years or so, although depending on, market conditions, sometimes you have to do refreshes more frequently than that. And it plays a really central role in terms of like what we're trying to achieve on behalf of the beneficiaries, the retirees, and the General Assembly for purposes of, the investment policy and our strategic asset allocation. So there are certain common factors like inflation that hit both sides, the liabilities, because benefits are driven by wage growth, which tend to be over the long term impacted by inflation. Inflation can impact our portfolio quite significantly, good or bad. It's also the case that some of the things that come out of the investment policy, like the expected return, that actually determines the size of the liabilities. That's the discount rate that's used to calculate the present value of all these future cash flows. So discussions we'll have in the future with the IAC in this context around like what's the risk appetite, what should be the risk positioning, that can drive not just actual results, but also the discount rate, and it impacts the funding policy and other things that are coming from the liability side. And then the final thing that is relevant is our performance relative to that assumed return has a big impact on the funding ratio, right? Which influences the ability to declare COLAs for the retirees. So, asset liability studies are pretty dry kind of topics, but fundamentally, it really does drive a lot of what people care about when you get down to who's paying for the retirement system, how much, when, what's the size of the benefits, do they take into account actual inflation, which we know has been quite sizable over the past 5 years. I think it's accumulated to, north of 20%, closer to 25%. And there have been really no COLAs for the retirees. So when you get down to the kind of 7-11 test, it's quite material, the resulting outcomes. Here's the key dates. So kind of looking forward, the payoff will be in November. That's when we'll come with our recommendations to the IAC. Before that, we'll have a discussion probably in August is what we're penciled in for, to talk about risk appetite and what are the key trade-offs to get input and guidance from you all in terms of how you think about the trade-offs. And then in January, the retirement boards, so there's a board for teasers and a board for Elgers, they vote on the actuarial assumptions. So there could be some fine tuning, in which case we would come back in February and bring up any tweaks. But that's essentially the cycle that we'll run. We'll preview the capital market assumptions and other types of assumptions that matter. And we'll come back on that. And then the asset allocation, the asset categories, again, these are largely driven by statute. But I think we'll also be talking to you all about perhaps a different approach on some of these asset classes, namely around real assets. What I've kind of seen over my years is a more standard approach to real assets is real estate, infra, and natural resources and ag. And I think that's an approach we're going to explore in terms of the modeling and see how that type of structure. We've historically had this allocation to inflation sensitive, which is again coming out of statute back around, I think, 08, 09 is when that was created. And it's actually worked out well in the higher inflationary environment, but I think we may be revisiting some of that. So that's the major initiatives.
Pause for any questions. online? Anyone?
Good comment, Kevin, very well thought out. Thank you. Good job on that.
All right, so I will go into the performance review and step through that. So again, a lot of slides that we put together because we feel it should be a rich amount of information, but the intent is not to cover this, slide by slide. So I'll be skipping through slides, and but we're totally open to any kind of questions you have and comments as well, feedback. So assets under management, we're sitting a little bit under 200 billion. Most of our growth, as you can see, has come from the retirement systems. So that's sitting at about 127 billion. But given the kind of good revenues picture for kind of the state, our cash management, and that's notably where that money comes from, is quite high at almost 44 billion, right? And then we have the supplemental retirement plan assets, which we oversee, as well as a allocation of about 3 billion to what we call ancillary. So these are small pools of excess cash that we invest on behalf of these agencies, state agencies, and I think some locals. And it's really just with some index funds. Right. So in terms of our kind of positioning and our view of the world, we really don't manage the plan with a strong kind of perspective on tactical asset allocation. But we do think it's important that we own those risks associated with the overweights and the underweights. And so we need to have a kind of a macro view of the world. So our current view is that, there's fairly robust global economic growth really kind of centered in the U.S. Europe and China are at different points in their economic cycle, and there's a lot of policy actions that will kind of determine how fast they grow going forward, and then what does that mean for their markets and kind of profit growth and such. But in the U.S., it's really this, we still think growth is pretty reasonable. The market perspective changes day to day in terms of whether they're more worried about growth or inflation. But we're trying to look out 12 and 18 months in terms of how we steer the overall allocations. As I noted, the last mile of disinflation has really been tough. We think that will continue to be pretty noisy. And there's so many things happening on the policy front that we just cannot fundamentally predict. So we're going to stay fairly neutral and flat to the extent we can and be focused on our rebalancing. I think the other thing we recognize is there's still a fair bit of kind of looseness in financial conditions. There's little tidbits of tightening here and there that you might see through some surveys, like the Federal Reserve does with lending officers. But because there's still a lot of liquidity in the system, there's a lot of uncertainty around policy. We expect that in the short run, there could be some really violent moves in the market, and just very concentrated, direction changes, whether it's in rates, predictions around Fed action, or certain sectors in the equity market. And that's just going to be life for a period of time until some of that gets resolved. We don't think that should dissuade us from our rebalancing. And again, it's just, these are risks we need to own and try to manage. So
Kevin, earlier you talked about versus the 2022 strategic asset allocation, modest, rotations into some equity beta risk. With respect to duration, and not really across the portfolio, because I think that's kind of can be difficult to model and is somewhat unstable, like duration risk within equities. Within just areas where you seek duration or take duration risk, what would you be versus policy?
Why don't you start with your book?
Sure. So we have been short duration because concerns of rates trending higher. And on the right side of that, part of the rebalancing model is to narrow that gap. We have been doing some of that already. So for example, we were like 0.5 short. Our projections pro forma of the money that we put to work is to narrow that down to 0.2 and kind of continue to narrow the gap there pending what seems to happen every day, the reality of it. But that was part of the program, Matt. And we've actually, coming out of the, we had a sell-off right when we were working on getting that memo signed on rebalancing. And kudos to the team on kind of being flexible. We were anxious to put it to work, and we got about $300 million. Really, the first day we had a hard sell-off, I believe it was the 12th. And then continue to get some to work before this recent push again, because we had a pretty material rally here in the last week and a half. So we had about $600 million in treasuries we got to work between the 12th and the 18th. And Kevin had asked me yesterday, we don't typically run P&L on individual line items, but out of curiosity, we went and looked at that too. And those pieces are up about 15 million, so about 2.5% in a week and a half. So it's really no great insight there, but we were fortunate to get it done. The last leg we moved in actually yesterday. We've been a little bit slower with the big rally. Kind of let's just pause for a minute here. And but the thought is to narrow that gap on out. And I wouldn't say it's with great conviction on where we're headed on the long end. I think we're probably somewhat range bound. I think Kevin even touched on it in there about the self-correcting term premium. We saw it back up, and then we saw buyers come in. And now we see this trade-off of, prior concerns about inflation pushing the long end up, and now we've got economic growth concerns that are kind of pushing it back down, and we've got a natural foreign buyer because domestic rates are still attractive relative to most of the foreign markets. So I think we're kind of range bound with a lot of noise in between here.
Yeah, thank you.
Yeah, and it feels to me like there's a lot of extrapolation of investors, whether it's retail or even institutional, that the narrative just keeps switching, right? And again, it goes to this point that, and this has been the case now for, at least a year or maybe a little bit longer, that the narrative switches, and it's either really soundly positive for equities or negative, especially the more concentrated aspects. And it's a 10% move in the equity market, right? Which is, happens in a month, and that should be like a year. But that's what's happening. And we see the same thing with the forward curve on short rates, or even the long rate, the term premium backing up. So,
which, interestingly, we've seen still within that going on, pretty limited volatility in credit spreads. 3 to 5 beeps on the IG side, despite all this noise and rally on it. And some of that, as we're seeing, demand is still heavy, and the new issues we've been involved in, still tremendous demand, just like we were seeing before. That part's not waning, and I think a lot of it because of the absolute level of the yield on them at the end of the day. And what I think is the trade-off too that we're touching around the credit fundamentals, giving some comfort there at the end of the day. But still a ton of laundry list of concerns that we have. The Fed independence thing is still there's been positive talk that which you feel like, okay, that's off the table more and we're in good shape. But then the Financial Services Committee announced they're going to examine about how the trade-off is of the mandate, this long dual mandate, to say, well, should it really be more inflation driven than employment driven or not? So I just think it's really hard to handicap.
Yeah. But Kevin, to your point, I mean, you're always tactically humble, but recent history supports that view.
Yeah.
Right.
Yeah, exactly. And I feel, again, it's good to contrast this with like 21 and 22, right? So there, I was somewhere else, but there we had a high conviction view that rates needed to rise. We had that view for a long time, as I'm sure others did, right? That on a secular basis, rates needed to go up. It's just timing, nobody can know that. But then as we saw the Fed start to move aggressively, then we had a conviction and we wanted to be underweight, long bonds, overweight growth, overweight equities where we could be. And that's a completely different situation than now, where I don't think any of us have expressed a view that we have a strong, high conviction view.
Yeah.
And we want to be more neutral. And we need to be thoughtful, not mechanical. But these are not environments where you want to lean, at least in our judgment, lean into a market position. Yeah.
Thanks.
So I'm skipping a bunch of slides just to the interest of time. And this is our asset allocation stance on slide 10 of this deck. That just shows where we were as of the 19th of February. So again, for the purposes of this slide, we're using the current approved strategic asset allocation. So that's 38% is our target for public equity. So we look like we're 5% overweight. And then you can see we're underweight areas. We've not been very active over the past 8 years, private equity, non-core real estate, and inflation sensitive as well. So we have notable underweights there that are not really intentional. We're relatively flat for opportunistic fixed income. So that's our non-investment grade fixed income. That's the best way to think of it. High yield bonds, leveraged loans. We have a whole series of managers there that do private special situations as well. Small amount of distress, not much, about 14%, I think, 12, 14% of that portfolio is distressed. And then multi-strategy, we look a little bit overweight. By statute, so I won't dwell on this in the future. We're in fine shape according to the statutory limits.
Quick question, Kevin. That percentage distress, do you think that's more than you actually need given the lack of distress we've had in this last cycle? I'm curious, how do you think about that percentage going forward?
Yeah, I don't think distress is an area we're leaning into at the moment or expect to. There's credit deterioration. I'll let Ron speak in a second, but there's credit deterioration on the loan side that I think is becoming more notable. I think the credit profile of loans versus high yield has kind of switched relative to historical kind of perspectives, right? In terms of default rates, current rates, as well as recovery rates. But Ron, do you want to talk about your view of distress?
Yeah, I think with the default rates being low in medium to longer term, it's not been the place for the portfolio to take advantage of distressed debt opportunities. There has been a meaningful increase in out-of-court restructurings, LMEs, liability management exercises that one might say maybe the default rates are higher than what one measures. But in terms of our portfolio, thankfully, we have a significant amount of flexibility where we're not beholden to having a certain percentage of distress, where our team and our underlying managers can pivot as distress opportunities increase, and they can pivot away and still earn a reasonable amount of returns based on the illiquidity and risk that they're taking.
Thank you.
Ronald Lundberg, sorry. One of the investment directors.
Fair to say it's deeply idiosyncratic, not thematic at all.
Correct.
Yeah. Yes.
Kevin, I've got a question.
Sure.
Kevin, this is Michael Kennedy. I've got a question on the equities. And unlike many other investors, public pension plans have moved much more aggressively to passive management over the last 10 years, if not beyond. But there's still a level of several that focus on active management. So now that you've gone and you've come back after 8 years, what do you think yours is going to be in terms of the breakdown of active versus passive? And what types of active sort of strategies, or at least managers or types of managers, do you think you'd be pursuing going forward?
Yeah, I feel this is a deeper topic we need broader discussion on. I'll give you my own perspective, though.
Okay.
I feel on the public equity side, we do need to right size active versus passive in that portfolio. We've perhaps got a bit more passive than I'd be comfortable with in the kind of environment we're seeing at the moment. And areas that I like where we're not well represented in our portfolio currently are foreign small cap, foreign activist strategies. So these are firms that would be more hands-on in terms of trying to influence management and boards and governance of companies. And I think I'm less constructive and historically haven't been very supportive of being active in U.S. large cap space. And my experience over the years has been it's a churn of managers. And they have organizational issues or they get something wrong in their investment process. So you turn them out, terminate, you bring a new one in, and then it's 3-5 years you doing the same thing. So no offense to Rhonda and all her efforts and her team and others at my other organizations, but I've always had this kind of, understanding that we're not going to be looking for large cap U.S. active managers. A bit more constructive on large cap global managers, particularly in what I think will be the environment going forward with, less cohesion across equity markets around the globe, right? So as there's been this decoupling, and particularly as tariff regimes come in and, regulatory, soft, impediments to integration across borders, I think there can be more value gotten because the capital might not flow in the way that people normally have seen historically when it was all one direction towards globalization. So anyways, that's kind of my philosophy. Yeah.
No, what Kevin's mentioned has been consistent with how we attempted to move the portfolio. By and large, the majority of our large cap exposure is passive, and we are eager and excited to kind of get more exposure to active management in those less efficient market spaces.
Thank you.
Thank you, Michael. The one thing I did want to point out here that we are reasonably close to the limit for our non-investment grade fixed income. So that's here it's called other fixed income above on that top panel, and then down below it's called opportunistic fixed income. And so the limit there is 7.5%. So we need to be mindful of that. Our rebalancing activity, we've talked about this at length. This just shows the actual tranches of when we move the monies out of pension cash, hitting fixed income first. Then we hit the first tranche of $1 billion going to public equities on the 19th. And then we have another transition within the asset class across managers with the transition manager. So that'll be happening in the relatively near future. I think to Jeff's point, we're up in a P&L sense on the fixed income piece, public equity. We're probably down a bit, but the fact we've waited on a part of it for planning purposes might work in our favor, but nobody can time these things precisely at all. So that's not our intent. And then in terms of new and incremental investment commitments, that $1 billion is the Russell Internal Passive Fund. 750 went to Jeff and team's portfolio, and then this the legal name is NCL3. It's essentially it's with a manager Ares. It's essentially co-investments. Yeah, that's a long-standing relationship. We haven't redeemed any, but there will be some coming up. And then this is our pipeline. So I won't belabor this, but I'll orient you all, and then we can talk more about this another time. But punchline, a lot of stuff in the pipeline. We've already not closed, but gotten approval from the treasurer of those first 4 rows. So it shows the asset class, the sub-strategy, and then are we doing a new thing or is it a re-up? And we designate whether it's an SMA, which is something we've privately negotiated, typically as a sidecar. Sometimes it has discretion retained by us. Sometimes the manager has discretion. And then the status, and then when we are targeting close. So we've had a couple of co-investments that are coming through One was approved by the treasurer. Another one will present it to him in final form this week in private equity. So those are single company investments that are coming to us through our general partner network, which the team, Craig Demko, Brian Bolkar, hold your hand up, Brian, and Sean are all on our private equity team. So they're beating the pavement to generate co-investment flow quite vigorously. And then you can see the other asset classes have quite a bit in the pipeline as well. We have a one-off co-investment for public equities, which has come to us through one of our growth managers, very high growth, very desirable co-investment, and we hope to present that final recommendation to the treasurer this week. That would be a March closing. So,
How would this look different a year ago? Is the team more active? Same level of activity?
I would say it'd be a third, maybe a little less than a third.
Yeah, more activity.
Yeah, more activity. Yeah.
Seeing good things. That's good.
Kevin, piggybacking Robert's comment there, how would this put us, if all these things happen particularly on the private equity side, how would it put us relative to the pacing that we were on under the previous leadership? Because one of the things I noticed in the growth part of the portfolio is we're underweight on private equity as well. I know you can't turn the dial on that overnight, but I'm curious, how we're working towards trying to close that gap as well.
Yeah, I think to be fair, it will require, the teams are quite busy already. It will also require augmenting the team. So that's why it's one of our major initiatives is we need to really get across the finish line on backfilling the team. So as I commented to you all during our one-on-one orientations, previously I think we were closer to about 45 people, and we're about half of that now, and that includes key individuals like in the general counsel's office to support the transactions negotiation, and compliance checks, and things like that, as well as on the accounting side. And we work closely with the CFO's area in the department. So we're pushing, and we'll continue to have a strong push to get things across the finish line. But there's no magic. We can't buy a portfolio that represents things that were missed, right? We can buy a portfolio to add. That's different. But the years that went by with limited commitments and activity, that's behind us. So that's just not feasible. But we are thinking creatively, and that's also why, again, we're bringing people on now.
Thank you.
Okay. Thank you.
It's also no surprise that the rise of the continuation vehicle market is something that we're taking very seriously and represents an opportunity for us to deploy material capital at material discounts into secondary transactions alongside our partners that we have. And so you'll see a handful of those things on this list already. And I know that's an area of focus for the teams because it represents really good value from limited partners who are impatient for liquidity.
Yeah. I think that's an excellent point that should get emphasized. Compared to a lot of other investors, the fact that we have this excess cash puts us in a really strong position, right? And because we do have a good experienced team with good expertise, we're able to move in market time. So, our message to the GPs, both the ones we have existing relationships with, historic relationships that maybe, got less active, is we're open for business, and we're quick to give polite no's, right? Which is valuable to the general partners who are looking to put together funding for some of these things like CVs and so on. So I think it positions us quite well, actually, in a lot of ways. Okay, so for the performance, The performance for the year, so this is the December 2024 performance, was good in the sense that we were in line with benchmarks. We didn't beat the benchmark for the year, but we were above the actuarial assumed return, which is 6.5% for the retirement systems. And you can see the long-term performance, and you can go back to 20 years. And our average performance is below that actuarial assumed return by virtue of our risk positioning over time. If you look at our attribution, I'll just have a couple sound bites. And there's some commonality between the 1, the 3, and the 5 years. So I won't belabor the point for each of these. I think what you see on the allocation effect for the 1 year is it was positive. And that was driven by virtue of the fact that we were underweight non-core real estate, which was the weakest performing asset class by benchmark. So by being underweight, that was favorable from an allocation effect. Cash actually was a drag in terms of allocation effect for the 1 year because it was we were overweight and it was a weaker return compared to the total plan. If you look at the selection effect, fair bit of negatives, right? 10 basis points for the year. And if you look at public equity, it's really being unbalanced, like I mentioned earlier in the discussion at the top of the meeting. Underweight U.S., that's painful. Overweight growth, also foreign growth, sorry. That wasn't great for us either. Private equity, non-core real estate, it's really kind of spotty coverage of the older vintages. And we have a lot of fund investments, which are very long in the tooth and down to kind of final remaining investments for some of those funds. So the best performance is behind. Opportunistic fixed income, narrowing credit spreads, really pretty good performance across most of the components of that asset class, at least relative to its benchmark. And then you can see some of the other asset classes had some positive contribution as well.
Kevin, the selection effect benchmarks, like for private equity, just for example, would that be like a Cambridge?
I'm sorry?
What are the selection effect benchmarked against?
Yeah, so
just for example, like are they all public equity related, or you would use like a Cambridge or a Burgess or?
Yeah, so it's go ahead.
Yeah, so for private equity, yeah, it's Burgess.
Okay.
Which is now MSCI. But yeah, so it's a blend of our underlying subcomponents of the private equity space weighted at policy.
Yeah. So the investment grade benchmark is reflective of the strategy. We run longer duration by strategy. So it would look like if basically if you took the ag and cut the first 5 years off.
Okay.
Which is kind of what we do in the portfolio.
Yeah, and I've jumped forward to the 3 years, and here the same effects on a negative sense are impacting the selection effect for public equity, private equity, non-core real estate. If you look at investment grade fixed income, the selection effect here is 33 basis points, so it's really the standout. And if I go forward one slide to 5 years, you can see on a 5-year basis, 25 basis points a year contribution favorably on the selection effect. So again, it's a very strong testament to Jeff and his team in terms of how they've managed that portfolio over time. And it's been very good. When I look at the long-term track record, what I see is there's couple of shorter time periods where there's been some underperformance, but the outperformance for that portfolio against, well-known transparent benchmarks has been very, very strong over the years. So, I used to say, and I still say, I never lost a wink of sleep thinking about our internal fixed income portfolio, which has not been the case with some of my other organizations. And it's not that it's passive at all, it's active. And in fact, we set it up back in, I think, 2013, so that they actually have a policy allocation of 10% within the portfolio to cash. And that's in their benchmark as well. And they're able to go in and out of the market to provide liquidity to the market, which has provided an edge, I think, in some ways to be able to, in markets where there's not really any inventory at the broker dealers, to be able to step in and provide liquidity and get paid for it.
Yeah, for the benefit of the new committee members. So really, when we did that back when Kevin was here, it was a reflection of two things. Reflection of concerns about where rates were, as well as we felt like a lot of things that came out of the crisis that were changing things at broker dealers, where we're having shrinking balance sheets, they weren't carrying as much inventory. We didn't think there was much of a bid there when something happened. It was like, listen, dry powder is going to be really meaningful in that market at some point. It took a while for it to play out, but what we saw during early COVID, when we saw IG spreads just blow out, we had a liquidity pool there to step in as a buyer. We felt were quality names on it, and while the Fed ruined it after a few weeks, it was dramatic. We could do what we were going to the market. There was no bids for a lot of paper. Oftentimes we were doing it on our electronic platforms, and we could see the cover, and there was often no cover. And we were buying even short paper, which wasn't normally our normal operating model. But for example, we bought Goldman paper short, like 2 or 3 years, like double digits. So I was amazed what we were able to do with that, and that opportunity went away quickly and half shut off, and we followed it back in and wait again, because I don't think anything has materially changed on what happens when everybody tries to run for that door, and that door is really small.
Mm-hmm.
Okay, so there's an appendix 2, just for orientation purposes, which I won't go to. Appendix 2 has all the asset class level detail in terms of the subcomponents, their performance, the structure, where we overweight and underweight. So for future meetings, to the extent that folks ever want to go deeper, the team is here, but the numbers are also there for people to look at. The other notable aspect, when I look at the 5-year and in particular in longer time periods, is the very negative allocation effect, and that's just from carrying excess cash. And so on a 5-year basis, that detracted more than 40 basis points a year annualized. So that's again why we want to continue to be more disciplined going forward around our cash allocation and not carry excess cash unless there's a clear and very high conviction reason to do that. This shows the growth of the dollar, and this is a chart we've used, for years. And the green is really excluding public equity and the public fixed income, the investment grade fixed income. This is our comparison against peers. So this comes from our custodian, Boney Mellon, and it's public funds with more than 20 billion of assets. The structure of this is a little bit different to illustrate some historical comparisons. So we show 3 panels: returns, gross of fees, because that's how the data comes, risk, which is standard deviation, and then Sharpe ratio. So you can see the 1, 3, and 5 years, and then there's 2 columns that show the 5 years prior to, was it 2014? So it's the 5 years ending 2019, and then it's the 5 years ending 2014. So one takeaway from kind of the shorter period comparisons is we've substantially underperformed the median large public pension fund. Our risk has been lower, but our Sharpe ratio, shows that we really don't have compensation for that lower risk. It's very different from if you go back before those last 5 years. You look at the 5 years ended 19 or 2014. There, we're quite close to the median fund. And back when I was here, kind of the soundbite that I would offer is, if you consider our lower cost fee structure, because we've managed a lot internally, especially fixed income, we could close about half of that gap. So that 7.56 versus 708, those are gross. We could close about half of that through our cost structure. Our risk was very low. And then if you look at our Sharpe ratio, you can see that we were actually top quartile. So that was very comfortable. We liked that. And it was similar for that period ended 2014 as well. I think, again, a big part of the discussion around risk appetite and positioning in the context of the asset liability study is, given how we think about capital markets going forward and what's the opportunity set and where will the risks come from, this is, again, something we need to, bear down on. How much growth risk do we want? How much risk and return can we get out of the fact that, say, interest rates are just going to stay higher for longer? I'm not presupposing everybody believes that, but if in fact rates stay higher for longer, then there's maybe some things we can do in size that's suitable for our risk appetite that could be a way to be more efficient in terms of the risk taking, and not necessarily just go to a much larger equity allocation, right? So I think that's where there'll be a lot of, fruitful discussion and input from y'all.
Hey, Kevin, quick question on that last page. How do you think about risk given the dynamics of illiquid lack of mark to market? Like when, and we haven't had nearly as much as peers, and like how do you incorporate that?
Yeah, I mean, I tend to, I use private equity as an example. And again, I'm just trying to be transparent around my own view, not put that view on others. So I don't see private equity really as being anything other than supercharged public equity. And it has a small cap bias. It tends to have a bit, especially in the buyout space, a bit more kind of quality bias, but it does have higher leverage as well on the balance sheet, not the fund itself. And so I've tended to, especially for asset allocation or asset liability studies, model the correlation between private equity and public equity as 95%. It's like they just sit on top of each other, because we're not investing really for 1 year, we're investing for 30 years. So we have to think about how these things correlate over long periods. There's some diversification value, but I don't see that as all that material. So when I'm thinking about portfolio construction, I think about it in those terms. I know these numbers don't reflect that because of the lagged effect and the appraisal basis for, some of the asset classes, private equity, as well as real estate and infra and so on. But go ahead.
The other thing I'd add to that is, because we have less private equity, because we mark to market much more frequently, our risk is, if anything, overstated relative to our peers here. And yet we're still in the 80th percentile. So magnifying that level of under risking is my response to your question. We are not just 80%, probably 90%.
That makes sense.
Yeah. That's a more direct answer. I'm learning.
Sorry in advance. Not really.
This just illustrates kind of the cumulative effect of underperforming the average large peer. And it's notable. I mean, this is the reality, right? We're kind of in the business of compounding capital contributed by employers and employees. And we can see that because of this under-risking, we've fallen behind pretty significantly. And that's part of the hole to fill in a deliberative way over time. Yeah. Okay, so I'm going to, I did want to touch on this. So this is our short-term portfolio or rate history, since it's sitting at about 44 to 47 billion. We want to include it. We have a couple of other charts around it. And historically, we've had a pretty good experience performance-wise for this portfolio. Again, it's very risk controlled. But the iMoney Net is kind of the top tier institutional money market funds. So they have a more varied type of instruments that they invest in that we don't.
More credit centric, yeah.
Pardon me?
More credit centric.
More credit centric, as well as really less interest rate sensitivity. So we go a bit further out and than the iMoney Net. But we see, that's kind of reversed itself now that the interest rate cycle is turning. Okay, I'm going to, in the interest of time, not go through these risk statistics. They're a bit stale in terms of the targets, and we'll be updating these. So this is on slide 27. And but I did want Chris to talk through some of the information on liquidity, both here and then there's another slide, I believe.
Yeah. So on the bottom part of this chart, just shows kind of our monthly net payment out of the investment portfolio. So the benefits, so the middle chart there shows it in actually dollar amounts and the bottom shows it in percentages. So as the treasurer's pointing out, it's a small amount every month that goes out between, some of them, sometimes 50 million to north of 200 million a month. So if you move forward to, that's, well, move on to one more. Yeah, so this one shows it annually. So by policy, we try to have less than 3% that leaves the portfolio annually. And you can see it hovered right around that dotted line, the solid orange line, hovered right around the dotted line for a number of years. But you can see the last 7-8 years that has come down substantially. And last year we paid out just north of 1% of the plan in benefit payments, I think just north of 1.5 billion. So we've seen that come down, mainly due, as Kevin mentioned earlier, due to kind of the funding policy of the board and of the state. So certainly less leaving the plan benefits all of us, but other than those that are putting money in. If you want to go, do you want me to cover the one before that?
Yeah, why don't you talk about the credits or the liquidity scoring?
Yeah, so this slide shows our kind of liquidity profile, both in terms of dollars and then percentages. So the top half shows just the straight market value of the portfolio. We categorize each underlying fund that we invest in terms of a liquidity level. You can see it on the bottom there. So level 1 is in blue. That's the most liquid, essentially T+3, and then it goes all the way to kind of the yellow there, the level 4, which is all the illiquids, anything greater than kind of 24 months. So by policy, we like to have more than 70% in level 1 liquidity. And if you can see on the top right there, the total NCRS, we're just south of 76% in level 1 liquidity. So we have sufficient liquidity, probably more than we need in terms of our policy of 70%. So,
quick question, when you define that 2, 3, 4, is that accounting for notice periods to get out of stuff? So that's
yes.
real time?
Yeah, so it's essentially, like I said, we categorize each fund. So if there's specific notice periods with hedge funds or there's specific time periods we need, we try to capture all of that within kind of how we categorize each individual portfolio.
Again, bottom line, we're awash with liquidity. Mm-hmm. We have very limited external demands for liquidity at the moment. It's something that we need to manage and be conscious of. But I feel, again, as we're talking about our intermediate term pacing plan and where we want to lean into, illiquidity is not a major concern for me. I think if we can get adequate reward for having our money incremental allocations somewhat locked up. I think that's, again, it's going to distinguish us as an investor in today's market. So I think it's a good thing for the plan.
But I would be careful in extrapolating the trend on 30 any further. We probably are close to our local minimum of net flows. Over time, we'll see what the experience study brings and how that impacts inflows from the General Assembly. But I wouldn't assume that this goes any further down into net liquidity needs. So
it would be a good thing if it actually went up.
Yes.
From any number of different stakeholders' perspective, including managing the plan. Yeah. Okay. This is our risk profile for the cash management portfolio. So this is slide 31. So you can see it's treasuries and agencies is where we focused. Repo at the moment is under 5% and very short duration at 0.8 of a year, good credit profile, all that. Okay. So that concludes the performance presentation. Any other comments or questions? Things we can follow up on?
I'll ask you one question. What could cause that liquidity profile to go to 3 or 4%? Let's say hasn't it's not on this chart. Never happened. Hasn't happened. But like what?
Talking about that stiff?
No, for this here, the thing that, the two things that would cause it to move up that materially would be if the contributions, which offset the benefit payments, start to go down, right? Which again, that's why I was commenting that would be a good thing from the employer standpoint, the cost of carrying that benefit structure. And then the other is the denominator effect, right? So one thing we'll show in the asset liability study is these are outputs of the asset liability study, and we can stress test how high it can go. I know with some other plans I've worked on, you could have a run rate of 3 to 4% next net external, cash requirements to pay benefits. And then with depending on how much equity allocation you had, it could flex up to, in 5% scenarios, to 10%. So it can be quite volatile in that sense. I don't think we've had that type of kind of modeling outcomes here. We've had such a low equity beta.
Right. The other thing that would cause it to spike would be if the employer didn't fund the actuarial required contribution, right? We've been fortunate here in this state that the General Assembly's funded it, I think, every single year, 100% of it every single year, except for 1 year when they funded like 75% of it, where other states haven't been so lucky. So they don't fund the required contribution, that could spike very quickly.
Yeah, fair. Okay. IPS update, is it fine to take that up? Yep. So I'll walk through a little bit of history here, and then the caveat and the thing I want to emphasize is we're doing this with all due respect to, these were decisions that were made by an earlier administration, and they made their decisions for certain reasons. I don't necessarily agree with kind of the conclusion. That's the fundamental aspect of this, but it's not to call into question the judgment. So when the study was done back in 2021 and 2022, the long-term goal, and this is typical for all asset liability studies, is to look at over the long term, how do you minimize the amount of contributions that have to come into the plan, right? Because defined benefit plans are really simple in that sense. Money comes in, you invest it, you grow it to pay the benefits when they come due over long periods of time, 30, 40, and sometimes even longer time periods. And so you want to strike that right balance between how much risk is taken in the investments. If you take too much risk or it's poorly executed, then you can have, unpleasant surprises that you have to top the plan up with new contributions or incremental contributions. So in the short-term goal, that's where that comes in. You want to minimize the funded status volatility or the contribution rate volatility that comes from being underfunded. There were 5 candidate portfolios that were examined. You can see the actual at that point in time, there was 11% allocation to cash. The target was 1%. Global equity was at 36% allocation, and the target was 42%. And then a whole series of other mixes were considered, all consistent with the statutory requirements and so on. If you look at it in a space that I think the investment advisory committee members would be very familiar with, of projected standard deviation of plan returns on the x-axis, the lower axis, and then the kind of the projected annualized return on the y-axis, it's almost like a linear relationship across all these different portfolios. So the actual plotted with a low risk and a low return. And then if you go all the way up to the northeast, you can see there's the target, which is in the middle of that cloud of 3. And then mix 5 was a very growth-oriented allocation, and that has 51% allocation to equities, 19% to investment grade, 1% to cash, and then 29% to everything else, which that's not too far off of kind of a typical public pension fund allocation, right? Now, when you, however, put it in a different space where you're looking at the asset liability metrics. So now what this is showing is something called ultimate net cost projected over 10 years. And what that means is the model calculates the amount of contributions that have to come in from the employers plus paying off any deficit that exists in the plan at the end of 10 years. Okay. So it's a measure of what really matters to the stakeholder, which is the sponsor. In our world, the sponsor is the General Assembly. In a corporate pension plan, it would be the company, right? Or a university defined benefit plan. Those exist also. It'd be the university as the sponsor. So then to orient around how the axes are set up, the bottom is the worst case scenario, 5% probability of that ultimate net cost at 10 years projected. And if you go from left to right, that's higher cost. The y-axis is the expected, so that's the average, expected ultimate net cost over 10 years. So there we have it reversed. So if you go up, it's less cost, right? So what the focus in the last study when this was done was really more weighted towards the short term, trying to avoid a bad outcome in a low probability scenario. And you can see the actual plots kind of lower risk, just like that mix 1 does. The target at the time is further up to the right, again to the northeast, and then the highest risk in a worst case scenario is mix 5. So our view of this now is that there's really not much differentiation between, say, the various mixes and the target that existed at that time. It's about a 2.5%, 2 to 3% spread in the tail, which is quite narrow. But there's a fair degree of difference if you look at like the target versus mix 16, which that is our current strategic asset allocation. So that's about $2 billion difference in cost over 10 years, which is, that's in our world, that's enough to be material. But the difference, if you look on the kind of the worst case scenario, the 5% is really not that much different. So our recommendation is to, go back to the old target, and that we need to have a more balanced perspective on kind of the long-term cost as well as the short-term risk. And if you look at it over 30 years, and this is typical for these studies to look at 30 years as well, I always, cringe a bit because nobody ever holds their strategic asset allocation steady for 30 years, right? But because of the long-term nature of these plans, it's worth at least understanding the dynamics. And here, it actually drives the point home even more, because here the actual, to use that, or mix 16, it doesn't matter, actually looks worse over in the tail scenarios of the worst case ultimate net cost than the old target. And then you can see the impact on the expected cost is quite material over such a long period of time as 30 years. So it's really just accentuating this kind kind of effect that already was shown for the 10 years. So again, our view at the staff level is that we should really move back to the old target for now. We'll do the full asset liability study, and then we'll have lots of opportunity for the investment advisory committee to weigh in on the risk appetite, the way we construct the portfolio from a policy perspective. I think for good order, we put in Callan's 10-year expected returns, so we're not signing off on these as like what we believe to the decimal point, but it does just represent what's happened since 2021, which we all know, which is that fixed income and short rates have gone up significantly, but the other asset classes are still projected to perform pretty similarly on the equity side and some of the other investment classes. So this is the change, just for the record, that we're recommending, that we go to the proposed strategic asset allocation, which moves up public equity target by 4%, lowers private equity by 1%. As you've heard, we have a lot of work to do on the private equity side to increase that allocation, so that is not a meaningful change. And then on the rates and liquidity, we're lowering the pension cash target allocation by 4%. Multi-strategy goes back to where it was before. And then it fits, these are the ranges. This is what goes in the strategic or in the investment policy statement. So I think that's it for the recommendations.
And if you, as this investment policy statement kind of review takes place, if you, throughout the year, we're trending towards a desired allocation closer to mix 5, for example, for most that looks like an endowment, which I know very different asset and liabilities. Do you have latitude to have meaningfully more risk than the target that you're moving towards now in the back half of the year, if that makes sense?
Yeah, I think we do, actually. Yeah. I mean, there are certain areas where we're close to getting capped out, so the non-investment grade fixed income. But for instance, we're very interested in, looking at commercial real estate mortgages and having an origination platform that could do seasoned as well as origination, and that would fit in one of the real estate asset classes. And so I feel like we have the ability to add some risk on the margin, still stay conservative, and we have the latitude. Yeah.
Okay, thank you.
Yep. That might not be true in 2 years, but it's definitely true now, just from a pacing perspective. And so you see on the right column of the slide, those are the caps where the policy target and the maximum is very close to each other. That's what we're saying there is we'd love to have as much as we can. But what we can is the far right column.
Yeah. Okay, so that's it for kind of the more formal presentations.
Can we get pictures on the screen just for the other ISC members? Are they able to do that just for the Q&A piece, or
To get their pictures from?
Yeah, sure. Why not? It does. I mean, I'm putting them on the spot a little bit, but just we wanted to have an open forum for Q&A for IAC members to the extent that they have it before we go to the public comment section. So happy to entertain any questions about anything we've covered today from the committee members, either in person or remote.
This topic as well is part of the Q&A.
Yeah.
So in a nutshell, this is what we're thinking of as the annual cycle. Sorry, go ahead.
Hi, Michael.
Yeah, I just had a general question since we're doing Q&A with the members. And, having worked with many other of the large public plans around the country, and this really gets into the so-called politics, because there are several general assemblies around the country that are more proactive in terms of passing laws that impact the overall performance and the investment strategies of public plans. Take a minute and give us a little color around sort of where does North Carolina stand, because many of us, haven't been in North Carolina for a while. I get the sense from a distance that the legislature has not been too involved and too proactive, but many other states have. So give us a little update and color around your temperature as to where that stands today.
Sure, I'll take it, and Kevin, fill in anything I miss. So there was a House Bill 750, I believe, passed now 2 years ago, precluding the investment management division from considering any non-pecuniary factors in the investment process. So that is in place. Doesn't change a lot of what we do, but that it deals with a lot of the more politically sensitive matters that do come before different pension boards. We're not allowed to consider them, be they issues concerning the far left or the far right or anywhere in between. So that's one. I think the big statutory limitations that we do have that the General Assembly has not addressed in 12 years is this legal list concept. One of the things that's falling out of that and is a recent development is there's a House bill authorizing us to consider investing in digital assets. Our response to that has been that digital assets are very interesting. The innovation that accompanies them is compelling. And as a state, I think we should probably welcome those businesses with open arms. We'll study whether those are appropriate for the risk and return of this plan, but it misses the broader conversation. And that is that we don't think the General Assembly is best suited to be prescriptive in that way. Where we think their best and highest use of time is setting the aggregate risk for this plan. So as we've gone down the road of proposing alternative governance structure with a number of legislators already, and we'll continue to talk to a number of folks around that, we have focused on what is the appropriate aggregate risk measure for this plan that the General Assembly or the Board of Trustees would set to try to get them out of the weeds and really looking at the forest instead of the individual trees. So those are really the comments I'd make around the political aspects of this. It is reasonably well understood that we have been a lower risk investor and a lower returning investor. I don't think as you stack it up relative to other pension plans, perhaps those numbers were quite as well understood historically. Over a 10 or a 20-year period, we are either 49th or 50th in the country in performance. And largely that is a risk choice. That is the decision to be in cash, the decision to be in fixed income. We have been a fiscally conservative state for a very long time. That's been a bipartisan consensus. So that's not new or should materially change in my view. But those conversations have been informed by those statistics of late, which gives momentum to changing how we do things around here. Anything you add?
Maybe just two quick comments. My own experience with the General Assembly here, as elsewhere, has been they're always interested in engaging. They're constructive. And I think if the department is willing to put the time in and effort, which I think has happened a lot with the treasurer already, it's always good conversations. So I think it's a great track record, as Chris said, by the General Assembly of always funding the plans. And I think the old approach we had was the risk was lower, but the investments were more efficient, right? We got more value add out of the investments. So we didn't have as much equity risk as a lot of the other public pension funds, but we were able to, make investments that paid off quite well and were low cost. And it was a great combination, I felt. So I think that's in our future. I think, so I love the fact that it's the long session, because that's when the legislature has the time to bear down on a lot of substantive issues.
If you go back to that ultimate net cost slide, just for frame of reference, you're talking about $40 billion of difference in ultimate net cost over 30 years. The total budget of the state of North Carolina is $30 billion. So when you start to talk in those terms and that scale, and it's $1.3 billion a year, if you want to think about it that way, this grabs the attention of people of the General Assembly. And how can we do this in a better way for everybody? The other piece of that conversation is the cost of living benefits or adjustments that Kevin alluded to previously. or lack thereof, I should say. Particularly in the local government plan, it has been 10 plus years since there was a cost of living adjustment enacted on a sustaining basis. And as we all know, inflation over that period is very material. That is not lost on anybody in their constituents.
Rounding that question out.
Okay,
No.
that's
No,
very, very helpful. Go ahead.
I was just rounding that question out. No General Assembly, no bills associated with geographic exposure, as maybe I think you've seen in some other states.
Not at this time, no, no. I mean, we've gone through, all the states have at various points in time, divestment, kind of legislative debates and things like that. I think the notable one, Iran, that's driven by federal law anyways.
Yeah.
Yeah. And that's a legacy, but that applies to everyone, just like Chinese military ban on investments. That's everyone has to comply with that.
Thanks. Sorry, Michael.
To be specific.
No, I was just going to say, I think, Mr. Treasurer, that's the right approach. And I think following that approach is going to lead to the retirees and beneficiaries feeling a lot better down the road.
I should comment on China, though, for a second, in part because of the Trump administration's announcement yesterday around evaluating banning certain types of investments into Chinese investments for different plans and fiduciaries in the United States. In addition to the geopolitical concerns of what divestment would look like or prevention of investment, there's a fundamental macroeconomic problem in China that we are attuned to, that we are thinking about how we reposition the portfolio as a result. So from my personal view, and this is an investment view only, it is very hard for me to make the case that it's rational to allocate new capital to China. Then the question is whether what you do own is worth selling, and we're wrestling with that question as well.
Brad, do you happen to know off the top of your head what our exposure is to China at the moment? On look through basis.
2 and change. Is that right?
That's all right.
The 2 and change %.
Okay.
Mostly public, but some private.
Got it. Thank you.
And can I ask if there's any feedback on what we're contemplating as the agenda topics for the future? One thing that we've done on a regular basis is to have individual asset class presentations so that you can see the whole team and go through their process and understand how they're approaching markets and so on. So that's penciled in at various points. It's usually 2 per meeting. The last meeting in February of 26, we've penciled 3, but that's just a placeholder. But to the extent that you'd like to see stuff done differently, it's not an immediate question or a question that needs to be answered immediately, but we want to be responsive to where the interests of the committee are as well.
I think the plan as proposed is pretty good. I think it's to cover 1 or 2 once a year is a good idea. More frequent is probably is overkill. And touch on process during, that's a good chance to touch on process as we're doing that, and strategizing about the future.
Okay.
Yeah, let's get to. I was going to say, I think it's a good idea as well, since we also get to see other members of the investment division share their views and perspectives on some of these strategies and markets.
Okay. Anything else on the phone, Michael, Lance, Jamie?
No, thank you all.
Okay, then we will go ahead and, thank you. That's all right. We'll go ahead and close the Q&A for IAC members, and we'll go to the public comment period. If you would like to read the procedures, if there are any public comments.
Currently, no one has signed up for public comment.
then I will declare the public comment period closed, which leads us to the least challenging vote of the day. We'll call for a motion to adjourn.
So moved. Also, just want to offer comment, like, I thought the material was great. It's so great to be with all of you. You do a lot of good and hard work for the state of North Carolina. Though I drove down from Virginia, I am a loyal North Carolinian. So I just wanted to thank all of you. Great stuff.
Thank you guys for being here.
So,
Yeah, if I could chime in as well, because I'm really thrilled to be part of this committee as born and raised Tar Heel, but 35-year resident of the state of Georgia, but North Carolina is still home. And my grandmother was in the plan. My mother was in this plan. So it's really exciting for me to have the opportunity to be a part of this.
No, likewise, guys, thank you for all your efforts and good job getting everything together. Got lots of fun.
so yes, so moved.
Thank you. We'll try a second. I'm going to go ahead and say that Mr. Ward seconded the motion. We'll call the roll, please.
Okay, for the roll. Mr. Brewer.
Aye.
Mr. Kennedy.
Aye.
Mr. Spencer.
Aye.
Treasurer Briner.
Aye.
We have approval.
Motion, the meeting is adjourned. Thank you, everybody, for your time.